couple of things to look at. Affordability. I've seen affordability get eroded away over the last couple of years. Mm-hmm. I also watched the Fed start to pump up the rate. Typically, they're pumping up the Fed funds rate because they want to build in a cushion. And they were very clear that that's what they were doing.
This is the real estate investing experience. We get it. Real estate can be rough sometimes. And that's why we bring in the experts to talk about the experiences you won't hear anywhere else. With your hosts, John Cohen and Chris Grinzik.
What's going on, guys? Welcome back to another episode of the Real Estate Investing Experience. I'm your host, Chris Grinzik. With me, as always, John Cohen. How you doing?
We're good. We're one of the crazy people that actually got a deal done, missed, all this coronavirus stuff. We closed on a property on Tuesday, and I pushed for it because I think it's going to be a great deal, and I am so excited. 100% rented, 95% collected in the midst of what could be not the best thing in the world for multifamily owners, but really well-situated property. So I'm excited. I had a really good week so far, and I think we're gonna, let's see what happens.
Yeah, no, I'm excited too. I really like it. Like we've said, it's probably one of our best pieces of dirt we own or have bought. So I think if you were going to close on a deal during this period, probably one of the better deals you could have bought, especially considering it being the B and C space. So very happy it was that one and not another deal. And
that's for sure.
Just happy, we were able to get it done. But yeah, so good week so far. But today got a really great guest on. I think, going to be a really interesting conversation. Really only been chatting a few minutes before this recording. I can already tell. I think it's going to be a really great episode. So I'm excited. But I'm going to let him introduce himself. So Lee, with that being said, thanks for joining us.
Yeah, thanks for having me.
Yeah. So can you take a couple minutes, tell us who you are, what your background is, where you're from, and kind of what you do?
Sure. Do you want me to jump into the most recent events or just jump right into real estate?
However you want to take it, my man.
Well, it's been an interesting month. So March 21st, I went to the ER. Mm-hmm. I had fever. I had a really bad cough and felt like I had pneumonia. They turned me away, said I wasn't sick enough, and went back into the ER March 25th with pneumonia and 104 fever. And 2 days later, got officially diagnosed with COVID. So I struggled for almost a week in hospital. Felt like at one point I might not make it. Mm-hmm. So it was a rough ride. A lot of misinformation out there. I think, as we talked about before the show, it's really in the eye of the beholder. People have very strong statements one way or the other, but until it affects you personally, I think that's what really shifts this thing. People have, well, why are we shutting everything down? You take away my freedom. Well, if your son or daughter's on a ventilator, you might feel differently about that. Mm-hmm. So I'm trying to be sensitive to the fact that people are looking at the media. The media is trying to almost put a political spin on this, even down to the drug that saved my life. It's now become a political issue. And to me, I think that people have lost their way when human lives become less important than a political agenda. So, for me, hydroxychloroquine actually saved my life. I don't know why it worked. It worked. I don't care that there's no FDA study. It saved my life, saved plenty of people's lives in Europe. And that's just my experience. And, nobody can take that away. But I also recognize that people are scared because there is no FDA trials. But do you let people die for 2 years until you get the stamp of approval from the FDA, or do you just try to save people's lives? It's tough. There's lots of unanswered questions, a lot of fear out there, and we're trying to separate the noise and really focus on the universe that we can control. The universe I can control is my business, the things that are going on in my life. I can try to be a positive encouragement to other people, especially in the education space, and give people hope and let people know that we're moving forward with our business, just like you guys. We're closing on properties. We're buying, we're selling. We're seeing great deals out there. We're able to help a lot of sellers the value of cash today, even from a month ago, has skyrocketed. The value of a seller getting real dollars in their hands and liquidity. I've just struck all sorts of amazing deals on property purchases, on vendors that want to get paid up front. So they want, or not up front, but they want to get paid all in one chunk. We've negotiated deals on that. I've just seen lots of people want to cash out. I had a sales guy that worked for us, and he was owed about $30,000 in commission over the next, say, 3 to 6 months whenever the deal is closed. And he said, I want the cash now. And I said, well, what will you take? He said, $5,000. So, that's crazy to me. But wow. The value for him of getting $5,000 today was worth foregoing $30,000 6 months from now. So it's just a weird time. It's definitely a weird time, but I think we're transitioning into the kind of market that really I built my last fortune on, which was, when the crap's hitting the fan, people are scared. Properties, even though the market may not be down 50%, you can get deals 50% off because you've got scared sellers. So it's the kind of environment I like. The herd's thinning. The professionals will be the only ones left. A lot of the daytime, HGTV type rehabbers are going to be gone because they were buying okay deals, spending a lot of money on them, still able to turn a profit. The market's not allowing for those kind of mistakes anymore. So, but yeah, it's definitely a crazy time. I think the sooner we get back to work, open things up in a way that's safe for people, I think it'll be better for the economy. The longer this thing goes, the longer the recovery is going to be. And I think it's going to be exponentially longer. If we're locked down for 6 months, it could be 10 years before things get back. But being down maybe a month, we could get back in 12 to 24 months. So it's interesting times. I don't have a crystal ball. I try not to presuppose or be an expert on things I don't know. But what I do know is that my universe is the thing that I'm focused on. My team, my businesses, I got 3 businesses I run, making sure that we not only survive, but are looking forward of what's after this. How do we take advantage of the new opportunities? How do we shift to market demand? So it's a shift of focus for me. When things are going along a certain way, just plug and play. And then the carpet's ripped out from underneath us. The rug's been lifted. So we have to now really look at, okay, what's the current environment? Where are things going? And in all 3 of my businesses, we have an innovation component. Almost every day now, we're innovating. What's the new market? What's the new demand? Where do we need to go? What do we need to change? And I actually like that. I like that we're back to being an innovative company instead of being plug and play, because it challenges us to be better every single day, realizing if we're focused on our business and making it better every day, that's how we're going to move ahead of our competition. And our competition at that point becomes irrelevant.
Yeah, 100%. I think one, we're thankful that, obviously you were able to recover and get better, and, very happy that you're going to be able to, now share your experience. Cause I think, like I was saying, you're one of the few, if the only one that I'm personally speaking to that I know that has contracted and recovered from it. I don't now, I know our accountant just got confirmed, but I haven't spoken to him. So it's really interesting to hear your take being in, call it ground zero of what's going on versus everybody else who's in and around and has relations, and everybody has a different flavor of what's going on. But yeah, I don't know about you, but I do think my take has been, I was pretty surprised at how much people jumped to give up a lot of things to kind of help it along, the social distancing, staying at home, quarantine, stuff like that. Maybe it's different from New York to where you are in Florida. I don't know. But definitely up here, I was pretty shocked at how quickly we're willing to move and adjust and make things work to kind of, better off society. You don't really see that a lot, right? People, like you were saying, people are very focused on their sphere and, what they're doing and stuff like that. And there's nothing wrong with that. It's not until something kind of enters that sphere that people really start taking a hard look at it and affecting their lives. And I think for almost everybody, it's come close enough into that sphere that, most people are kind of taking a lot of steps necessary to at least help with, lessening the impact on, healthcare and medicine and, all the other stuff. So I don't know if you feel the same way.
I feel like there's a lot of extremes out there. I mean, I've got people that are ready to, go to Capitol Hill and fight with their guns and, fight for their constitutional right. And then I got other people who are scared to death and are in shutdown mode. So I'm actually, in my circle, I'm seeing all sorts of extremes. And I think it's brought out a lot of good in people, and it's brought out a lot of selfishness in people. So I've seen really both sides of this thing, but I also understand it. I'm not as judgmental because I recognize when I see someone, you can't tell me to stay home, you can't take away my rights. They haven't been personally affected. And, they're reading a number of 20,000 people and 327 million people in the US going, there's more people got killed probably in car wrecks. I don't have that exact statistic. By the way. I get but generally speaking, the net deaths in this country are down because all the things that people normally die from right now staying at home, they're not dying. And you factor in the coronavirus number, my understanding from research I've done is that net number is way down. So death rate in the US it's really, it's down to perspective. But I think it's a good time for us all to be understanding, walk a mile in someone else's shoes, and realize that, you know, it's all down to perspective. And there is just so much misinformation. I mean, I talked to a friend of mine, and his circle, his network was scared to death of hydroxychloroquine because of what they'd heard. Then when I told him my story, he goes, people need to hear this because there's no politics. You're just saying I was going downhill. I wasn't getting better. The drugs that they were giving me, which was Levaquin, they actually ran out of zithromycin. They gave me wasn't working. I was getting sicker and sicker, less oxygen, less ability to breathe. Within a day and a half, that drug turned me around. So, but that's my experience. You can't take it away, but I also can't tell everybody that. And I recognize they read an article and now they think there's some political agenda or, 5G is trying to fry our brain. I mean, there's just so much craziness going on right now. But I'm trying to be sensitive to the fact that people just don't know. And I would encourage everybody out there, just walk a mile in someone else's shoes. Try to understand why they feel the way they do. And this is not a time to be judgmental. This has really stopped everybody in their tracks, stopped the entire world economy. Most people don't know how to navigate that. So I'm trying to lead by example, move forward, let people know why we're moving forward, do it intelligently in business and in life. And I'm also recognize that most people, when something catastrophic happens, they go into shutdown mode. You see it like, if there's a major wreck or a ship sinking and people just freeze and they're just standing there and watching the ship sink because there's other people who are taking action and getting lifeboats. And you see this a lot in life. And so this is just on a much bigger scale. And I'm trying my best to not be angry and not be affected by that and just try to really focus on being understanding and empathetic with people, recognizing there's just the full gamut of crazy over here to crazy over here. So.
Yeah, no, I think, context is key in anything. And especially today, like you said, who knows, just from the medicine side, and not to get way off topic, but who knows what with you made it work? And is it for everybody or not for everyone? The context of your extremes of your circle of, I'm ready to go fight or I'm ready to bunker down, underground. Who knows what their context is? Who knows what they've gone through in their life that makes them feel that way. Or lack of context for them. So I think that's a really great perspective to, especially today, always, I think not judging people is a really good way to live life, but especially now, you never know what's going on in somebody's life and what things have affected them and who they've lost or who, what things have happened in their past life that make them react a certain way in such a, fearful, unknown environment. It just amplifies everybody's emotions. So I commend you for, your approach and, how you're looking at things and, just saying what you can and know for certain and not trying to spread, extra fear or being the advocate for this drug and saying, hey, saying this is what we need to be doing. So I think that's a great approach. I do want to backtrack a little bit though.
Sure.
Cause you touched on, stuff you're doing in real estate and business and things like that. Can you give us a little bit more context of what you do, what you're involved in, and how it's grown from whenever you started to now?
Sure. Well, I started flipping houses in 2003 by accident. I bought a house, got broken into, put it right back in the market, sold it 3 months later, got the taste of real estate, made about 30 grand. I was like, I just made more money in my job than, and I did this by accident. I just bought something and sold it. So I was really intrigued by real estate, moved to California in 2004, flipped a couple houses out there, found a coach, really recommend to people, that first person walking me through his rehabs, showing me what he spent money on, what he didn't spend money on, why he spent money on, where to buy, what price point, how to understand comps for your exit price. This was back before Zillow. I mean, just it was the Wild West. When I think about how I was doing real estate 17 years ago compared to how I am now, it's funny. It makes me laugh in a lot of ways. But he really gave me the formula. And so I was scared to death to go outside the box. So I drove around 3 months, hired this little old lady as an agent to send me deals, landed on a probate, didn't even know what a probate was. Finally found out afterwards that the person had died in the house. And, there's a funny story on that. We're at the closing table and the buyer said, is there ghosts in the house? And he wasn't willing to sign until I said, it's ghost free, 100% ghost free. And sure enough, the buyer signed it. So it was an interesting time. So did a couple flips in California, moved to Florida, started buying at the auction. I just asked a lot of questions, and I would encourage people, ask questions. They're not dumb questions when you don't know. So with our students, I'm always very, empathetic with those questions, because I was asking some of those questions at the beginning. They're not dumb questions when you don't know. So I started buying at the courthouse steps, had to navigate through that, self-taught, turning numbers into addresses and case numbers and trying to understand the whole foreclosure process. Really ramped up between 2005 and 2007. Then woke up mid-2007, realized the market's going down. I'm losing my shirt. I'm buying houses into a downward market and adding value. In some cases, was selling houses for less money after rehab than I paid before. I mean, it's crazy time. So 2008 basically gave back all of my winnings in real estate. I was up a couple mil, now I'm down a couple mil. I'm just basically broke. So I realized I made a couple of key mistakes. One, I was so focused on my business, I wasn't looking at the market. And two, because of that, I was on the wrong side of the trade. I should have been wholesaling, day trading real estate, eliminating risk. And wholesale by nature transfers the risk to the buyer, because you're just sitting in between the transaction. You contract the property, you sell it, the buyer assumes the risk, you collect your fee up front. And if in a rental strategy, you're assuming lots of risk because you're taking the property on long term. But as a wholesaler, you're day trading real estate. And so I quickly transitioned to day trading real estate, started to capitalize in 2009 on REOs, actually came out with REO Rockstar, which is a dinosaur course at this point, about 11 years ago, teaching people how to buy and sell bank-owned properties. So I was buying them from the bank, selling them to local investors, day trading real estate. The market was choppy between 2009 and 2011. It was a great time to be wholesaling. So we made a lot of money just wholesaling. Then as the market started to get stable again, we started buying and rehabbing, doing all the things we're doing now, build up a rental portfolio, sold most of that, went from over 300 doors to now, I think 10 in the last couple of years, because I recognize prices are getting high again. So one of the key things I think that makes me different, I've been through a crash. I've seen the ups and the downs of real estate. It's not my crystal ball. You go onto Zillow, you look at Tampa, you look at Vegas, that's two good bellwether markets. You'll see prices were here, they're here, now they're back up here. So it doesn't take a rocket science to realize these are cyclical markets. For California, Nevada, Arizona, you've got Florida, markets like that are very, very cyclical in nature. And that's one key component if you want to maximize your wealth in real estate and really, 2 and 3 and 4x in the next downturn, which I believe we're kind of at the beginning of that. It's understanding when to buy and when to sell. It's not always the right time to buy and hold. It's not always the right time to sell. I mean, if I'd sold my portfolio 3-4 years ago, I would have left several $1 million on the table. So it's important to understand when to buy and when to sell, especially when you're holding properties. In some cases, when it's time to just day trade and make sure you don't assume the market risk. And I definitely think we're coming into a time where you want to beat up deals, make sure that you underwrite low comps, high rehab, make sure you really try to beat up the deal. If it still comes out the other end and the numbers work, then buy it. But we're certainly not forcing deals to work. We're really, really conservative at the moment.
Yeah, I think I tend, a lot to unpack, but tend to agree. This is probably the start of some sort of a, downturn, recession, whatever you want to call it. Who knows how long it lasts or how deep it gets. Just for us, just because of the lack of, capital and borrowing ability right now, anybody that owns a property, your valuation has basically been slashed for the immediate future. Who knows where it is in 6 months or when quarantine ends or, things come back to whatever level they get back to. Could be right back to where it was, could be much lower. I don't think it'll be higher, but, who really knows? But yeah, for the immediate future, definitely tend to agree. What was it? Because I think it's interesting, not as many people, especially in the, talk about it on social media, podcast space, have necessarily been through the downturn. Was it just the pricing that kind of gave you some indications that, maybe we're getting towards the top of it? Were there other things that you saw that kind of,
yeah. Let me touch on those. I'm going to drink a little bit of Robitussin here.
Go for it.
I'm going to go rogue and drink it straight out of the bottle on your podcast.
There you go.
So a couple things to look at. Affordability. I've seen affordability get eroded away over the last couple of years.
Mm-hmm.
I also watched the Fed start to pump up the rate typically they're pumping up the Fed funds rate because they want to build in a cushion. And they were very clear that that's what they were doing. So you kind of know you're at the end of a cycle when you see affordability go down, when you see people like having DTI issues, you know, their debt to income, because they're trying to make the numbers work. You know, most people are at that 1/3 that have bought in the last couple of years. So 1/3 of their income is going on their mortgage or their rent. Typically, you'll start to see everybody and their mom jump into real estate. What have we seen the last couple of years? You know, person cuts your hair, a person's bagging your groceries. Everybody's a flipper, right? Everybody's a real estate investor. Everybody's an expert. You know, all these newfound gurus. And I saw the same thing last market cycle. So I've seen lots of indicators in my world that were eerily similar before COVID, by the way. This is literally nothing to do with COVID-19. It's just, I've been sensing this. And I've also seen the price. I look at the data. So besides what my gut's telling me, what I see in my circle, I've also seen the prices. I've looked at those graphs, and it can't continue up. You look at 2011 to 2019, in most cases, it's just been an upward climb. It can't continue. It just can't continue because at some point, the cap rates don't make sense. I mean, when I started buying my rental portfolio back in 09, 10, 11, 12, we were buying at 15% cap rates. I mean, just crazy numbers. You know, even on a gross rent multiplier, which is where you take your purchase price, divide your rent, look at that multiplier. We were buying it in a lot of cases 30 and 40. And now you try to make your rental work, you know, what's the rule of thumb? 100, right? I was buying it less than half that, in some cases, 1/3 of that. So I have history where I look back going, okay, it was here. I saw it up here. I saw it at 100, 120 gross rent multiplier. I've seen it come down to 30. Now it's back at 120, 150 in some cases. I mean, people are just, you know, we're competing against investors here in the Bay Area that are still buying at 4 and 5 cap. I don't know how to effectively manage a rental and not lose my shirt at a 4 or 5 cap. You know, with my cost of capital, I don't know how to make that work. I don't know how to make sense of the deal. You know, I've been attending seminars for the last couple of years, and they're talking about understanding the psychology of a renter to make sure they don't move out, which one's going to stay longer. When you've got to get into these kind of things, you realize the show's over. So I've seen so many indicators that have nothing to do with COVID-19 that says, hey, we're approaching the end of the market cycle. You know, and also free money. You know, you see 95% leverage. Most institutional lenders before COVID, it was anywhere from 85 to 90% LTC, which is loan to cost, anywhere from 85 to even 100% of rehab. So basically, they're 100% funding properties. And in fact, some of these lenders 120% if they fund the rehab up front or even more. So all the things that I saw last market cycle, I've seen over the last couple years get worse. And so my position, and you can look back in podcasts from 2 years ago, I've been very clear that I've said we're coming to the end of the market cycle with it nothing to do with COVID. I think COVID is just the catalyst that stopped everybody in their tracks. Now we have a point in time where everybody stopped paying rent at once worldwide. Everybody stopped paying their mortgage at once worldwide. And so it's beginning of what was probably already heading that direction anyway. And there's lots of data that shows pricing has flattened in places like South Florida. You know, you look at the Miami condo market, considered another bellwether indicator of real estate. It's the first one out of the gate when things are going up. It's the first one to crumble. And so that's been a market I've been watching, and that's been in slow decline over the last couple of years. So all the indications are there. It's not just one thing. And it frustrates me when people try to paint a general picture. The market's going up, the market's going down. Every market's different, but generally speaking, all of the economic indicators have been indicating that we are approaching the end of that market cycle.
Well, I think I've been saying the same thing. Is just, COVID was the kick to the teeth. It was the punch to the face that just knocked you to your knees. Where before things were getting swept under the rug or overlooked, or people really weren't backing into things. I know I talk to Chris every day, and we joke around when someone sends us a deal, and it's oh yeah, don't look at the cap rate, look on the cash on cash. I'm like, how the fuck do you figure that out? How do you your cash on cash, if you buy cash, is your cap rate. Your cash on cash is a debt factored instrument if you get debt, if the debt market's not there. So they all go together. And for a year and a half, and we've bought deals through it, but there are sometimes you get deals, and Chris sent me an email the other day. I'm like, how do you respond to a guy like that? Like, it's just completely insane. Like,
Yeah.
But I've been saying the same. All this did was put the defining line in the history books of when people got punched in the face. It doesn't mean that this was the start of it, or, oh, it would have been roaring for another 5 years if this didn't happen. It could have went for another 2 years or 3 years. You don't know, but this was the the fun, the wind's out of the sails. Let's see what happens. And I've been saying the same thing. And none of us can predict the future. And 2016, I thought the world was coming to an end. 4 years off, but we've taken advantage of situations through those 4 years. So you're never going to be right. You just don't want to be really, really wrong.
Well, one of my mentors, I felt, gave some really good advice on this, and a lot of the advice I'm giving you is from my circle, which is, got a zero more than me in some cases, and a couple zeros more in one other case. Very, very smart guy. And what he told me is that, he actually agrees with where we're at, my assessment of the market conditions. So he's been really coaching me, showing me data to show me that, we're at the end of a market cycle. To your point, does it mean it crashes? No, but things will have to flatten out, because real estate goes back to a couple of things: building cost, land cost. When we look at intrinsic value of what the house is worth, what does it cost to rebuild? What does the land cost? And on the rental model, what does it rent for? And it's at some point when the rental model doesn't make sense, that will cap out the price. And so when you look at replacement costs, that actually raises the value. That's when things start to get torn down, right? Because you've got the building costs and the land value, and you end up in an upward cycle starting to tear down houses that before would have been rehabbed. So there's fundamentals in real estate that are out of whack right now, and they have been for a couple of years. And so that alone would dictate that something needed to change. And what happens at the beginning of an economic cycle, people are spending more than they earn. What happens at the end of the market cycle, the economic cycle, even besides real estate, you got to start paying it back. So you either have to spend less, which slows down the economy, or you go into default and you keep on spending, but you default on those loans. So I think it's all just kind of hit that point. And you're right, it's the kick in the face. It's just, that's the thing that just stopped everything in their tracks and stopped everybody worldwide. So I don't know what that's going to look like. I mean, you look at trade, international trade, it's crazy. Containers haven't been coming over now for 4 to 6 weeks. That's going to affect lots of things in this country and every country, because stuff's not moving around. And they're saying that even the ports reopening, it could take a couple of years for them to ramp back up, because the entire supply chain has been messed up. So there's so many unknowns with this. And, you look at the unemployment filings, these are real numbers. This is now a bunch of people that have got onto government assistance all at once. You've got 22 million Americans, last I saw, file for unemployment these last few weeks. Shocking numbers. But where that all translates to real estate, I think we can see it's going to be a grind down. It's just whether it's going to be quick or slow. And so I'm trying to look at all of the factors and realize there's no free lunch. And what I mean by that is the stock market doesn't crash and real estate's fine. You've got real estate doesn't crash and stock market's fine. You'll find that investors can substitute their investments, so things move together. And even within real estate, people think they find I found mobile home parks. No, there's no free lunch. If you're getting a better cap rate, it's because there's more risk associated with it. The assets are worth less, and the market makes those adjustments. So whether it's storage, multifamily, commercial, single family, trailer parks, vacant land, the market will adjust for any inequalities and make sure that everything reaches that normalized return. So generally speaking, I think we're just in for choppy waters for the next few years here. I think real estate particularly is going to go back to whatever that support level looks like. But it's got to be a bargain again. It's got to be a bargain for someone to want to part with their cash. And right now, the current pricing is not a bargain. And what I saw last cycle is that the transfer of wealth was the people that jumped in at the bottom versus the people that lost at the top, which is why my mentor said it's not important to call the bottom of the market. It's important to call the top, though. So we're really trying to reduce risk, beating up deals, selling our rentals, making sure we do shorter rehabs instead of harder rehabs. I mean, we're not doing complete gut jobs at the moment. We're making sure we do paint, carpet, maybe don't have the prettiest house on the block, but we have the cheapest house on the block because our basis is lowest. So these are things that we're doing as a company, wholesaling more, rehabbing less. Generally, we're trying to swing the needle of risk away from having market risk, shorter revenue cycles, and making sure that we're adjusting our purchasing as we see that there's risk on the dispo side, prices are settling down, maybe stuff's not moving. If you got an entire subdivision where nothing sold the last 60 days, what is the resale price? I don't know. I don't really want to know. So therefore, I'm going to try to wholesale in a place like that rather than assume that market risk.
Yeah. You touched on something that I think is interesting, that I think would be good if you could go into it a little bit, because I think I caught it. I think I did, but I think a lot of people would have missed it. You touched on spending in the beginning of the cycle and paying for it later. Can you just expand on what you meant by that? Because I think it's going to help a lot of people.
Yeah, absolutely. So economies are driven by one word, in my opinion. And this is, people a lot smarter than me that have drilled this into my head, spending. So spending is typically dictated by confidence. So when people are confident, they open their wallets, they spend. And so, we've been in an upward climb. People have been confident, people have been spending, and that's why the manufacturing index was on the way up. And now the last couple of years has been on the way down because people are spending less. And the reason people spend less is because they're A, less confident, or B, they have to start paying back that over borrowing. So at the beginning of the cycle, if you're taking out a bunch of loans, what you're doing is you're spending more than you earn. But at some point, you've got to start paying those things back. You've got unsecured credit cards, car payments, things like that. It all works together. And at the end of that cycle, certain people are going to start defaulting. The people have to start paying it back. But as soon as people close their wallets, which is for various reasons, and start hoarding cash, that slows down everything. That's what causes a recession. It's a lack of spending, because that sends everything back to the car manufacturer. People, instead of trading their car every year, are doing it every 3 years or 5 years. Now they got to make less cars, right? They're buying less metal. They're buying less raw materials to build that car. So that's where it all trickles back. I didn't mention that earlier. One thing I've been watching the last couple of years is the manufacturing index, and you'll see some major cracks in the armor. You'll see that manufacturing index has been really tapering down the last couple of years.
Interesting. Now, I think you touched, the loans and the debt side, I think is very important. I know, we try to give back, to the community through podcast meetups, different things like that, and, outreach on social media. And one theme that I've found very startling is how cavalier people are with debt. It's mind-blowing. There's countless times where I've spoken to people and something will come up, and especially on real estate, which is, mind-blowing to me, is that, I'll ask questions like, what's your break-even occupancy? Or like, what's your debt service coverage ratio? And they go, what are you talking about? And I say, well, you don't want to over-leverage your properties. And the response I get is, if the bank is going to give me money, why would I take less? And I try to explain it to people, and I feel like I'm banging my head against the wall. And I'm hoping that anybody that's in that position that is now strained, that hopefully they get taught their lesson over the next 3, 6, 12 months without, losing everything. Obviously I don't want anyone to crash and burn and never recover. But if you're early on enough, this is going to show you exactly why, debt can be a phenomenal thing. It can also be a very bad thing. People want to shit on the stock market when they're real estate investors and things like that. But if you own an index fund or you own a stock, you can't really owe more than you put in. You buy a leveraged real estate property, you can definitely owe more than you put in, especially if it's a recourse loan. So everybody wants to talk about the upside and the benefits of leverage on real estate. Nobody wants to talk about the downsides. And whenever you talk about leverage on stocks, like margin calls and stuff like that, it's the worst thing you've ever heard of. It's the most risky thing ever. And it is, but they don't think about the same type of thing with debt on properties. And I've just never understood how so many people can't understand that concept.
Right. A lot of people are underwriting multifamily and single family less than $100 a door.
Mm-hmm.
I mean, I've owned property for over a decade. I know what the long haul of the property looks like. Things wear out, things have to be replaced. People don't realize, to your point, that the returns in year 2, 3, and 4, when stuff starts breaking, all has to be factored in. So, we had a loan a couple weeks ago, actually it was a couple months ago at this point that closed. And I think the bank has offered up to 75%, but we capped it at 65 because, we saw a payment of $950 on a $1,200 rent. And I said, no, we want to get this thing down to $750. So we made sure to build in a margin of error where we would actually cash flow. I mean, let's take $100 a month. If you take $100 a month cash flow, sounds great, right? $1,200 a year, get 10 rentals, $14,400. I'm a rock star. Get 100 rentals. I got 144,000. Never have to work again. Okay, the water heater breaks. You spend, $500, or let's just say it's something more major. The AC, it's $5,000. Go straight for the disaster hit. At $100 a month, you will make no money on that property for the next 4 years. Cool.
I talk about that all the time when some people, they send me these deals and I said, that's great if everything works. But inevitably, even if you buy a house, brand new rehabbed, shit's going to go wrong. It just happens. It doesn't always work. And, Chris brings up a good point because no one talks about it. That, as a debt instrument, you owe the money and you can't, $100 a month is great until something breaks. And I tell people all the time, like, there's a lot of people that like to buy, and I don't knock it, turnkey properties. I said, turnkey properties are fine. There's nothing against them. I have nothing against them. Listen, you want to buy them, that's good. But, the roof goes, the AC goes and stuff like that. Your property is now making zero for 2 years or 3 years or 4 years, whatever that problem is. So,
absolutely.
And people don't, 12%. I'm like, okay, that's great. That's fine. But your 12% turns into zero very quickly if something goes wrong. Not saying that, buying a multifamily is the answer or flipping a house or an answer or wholesaling is the answer, because it's not. I mean, you can do all of it, or you could pick something that you really like. But those are things to consider. And, I laugh when people are like, oh, well, look at this. The average rent multiplier is X. And like, yeah, that's great. But you have no CapEx. You're running this at 96% economic occupancy. I can make any deal work. Correct. by a function of 3 or 4 changes, any business plan. But, that's not why you shouldn't have to find a reason why the deal doesn't work. You should have to find a reason why the deal does work and beat it up as much as you can. Because little things like that, when you factor that in, okay, imagine you want to own 100 houses that all make zero. Talk about the liability and risk that you have on your table. I mean, there's nothing fun about that.
Yeah, that's the situation I found myself in 2008. Every rental I had was negative cash flowing because stuff did break, because I had $900 payments on $1,000 rentals. There's nowhere to go.
Yeah.
There's nowhere to go with that.
No, I think part of, you touched on it inadvertently when you were talking about higher cap rates and risk reward. I'm starting to realize that most people don't have the understanding of how to analyze the risk of deals. They just look at the returns and what's projected, and they just use the numbers they were given, whether it's from, like our passive investors looking at a syndication, or somebody taught them how to underwrite, or the property manager gave it to them, or God forbid the broker gave it to them. They just take it and look at the return and they say, is that return good enough? They don't say, is that return good enough despite these risks associated with, whether it's location, whether it's asset, whether it's deferred maintenance, whether it's the amount of leverage, whether it's the crime. I mean, I could, 10 minutes talking about all the risks. Nobody weighs it up. So back to your point where it's a 12 cap for a mobile home park in the middle of nowhere, Missouri, that's significantly riskier than, a 100-story skyscraper in downtown Manhattan. It's not.
Correct. If you go back to the underlying value of the asset, I would argue the trailer with no tenant is worth zero.
Mm-hmm.
It probably needs to be torn down. So that's the problem. It's only worth what the income's producing. And so that means you don't have an underlying asset value. So you've got to discard that and be just looking at your cash flow. On those kind of projects, I want to get my money out in a couple of years because I recognize all I got is a bag of wind. I don't actually have anything worth something. So, when we own or finance, cheap property, we try to get our money out in 24, 36 months. Now I see people own or financing the same deal, trying to get the money out in 5 and 6 years, but they have an underlying asset that's essentially worth zero. So another consideration, I think we talk about variables to swing the needle. If you're owning a rental, there's a couple factors that will determine whether you make money or not. The tenant staying, number one, the tenant. So that means every time the tenant doesn't stay, you've got to turn the property. The second thing related to that is how much damage they do. Because if they stay, leave it in broom swept condition on the 30th, and you rent it on the 1st, no cost, right? It's just been a blip on the radar, unless you had a property management company where you pay them, a lease-up fee. So that's your best case scenario. But by the way, that never happens. It's typically a 1 to 2 month gap, and there is a turn cost. Our best turn costs are $500, all the way up to maybe a couple $1,000s. We found it was about a $2,000 to $3,000 turn in a single family rental, which is why we really focus on people that would not only pay, but would stay. And so that was a key component for us. So again, paying, so which is, them not going into eviction. The staying, we want them to stay longer. We want them to stay for years and not a year. And then the third thing we want with the tenants, one that doesn't do a lot of damage. So this is where people that are experienced operators understand how to screen tenants, talk to previous landlords, realize that the stork didn't drop off the tenant. When people have, an ambiguous rental history, I already know they were renting somewhere. They lived somewhere before they came to me. Unless I get a really good answer and a good feeling about how they left that property in what condition. So we've done certain things like raise the deposits, but we've also rehabbed our houses a little bit nicer. So what happens is, even with Section 8, people have mixed opinions. I've had a great opinion because we went after the best Section 8 tenants. So we would provide the best property with a slightly higher deposit. Just raising the deposit weeded out all the people that were going to trash our properties, because your bottom tier tenant's going to be fighting over the deposit. And if they're fighting over the deposit, guaranteed they're going to be delinquent at some point, because they're just trying to scrape together minimal money just to get in your property. So we looked at the key things that really helped us identify tenants are going to stay, tenants are going to pay. Same thing as a job. If you're interviewing someone and their entire resume is them moving every 6 months from job to job, you're probably going to be the next person they work for 6 months. I like to see resumes where someone stayed at the job for 5 years, 6 years, 7 years. Cool. Now I'm hiring someone that's going to stay. You get good answers as to why they left. Same thing with tenants. Rehab is key too. We put all of our money behind the walls, which means we don't have to rehab the house. A lot of people try to put a patch on a rental, then they're having to refix the home continuously. So there's a lot of lessons we've learned about rentals. Rentals are great. But I would argue if you buy them at the right point of the market cycle, in markets that do have a cyclical nature, you can really juice your returns. I mean, our average rental, this may shock you, went up over 200%. So I had doubling in value alongside cash flow, for 7 to 10 years. So I was really happy with where we bought and where we sold. And the problem is, if you buy at the peak of the market, you're not going to have any kind of appreciation. So you're fully reliant upon that cash flow, which means you got to make sure this thing is actually going to cash flow in year 2, 3, 4, 5. Now, the good news is, even if the cash flow is minimal and you have an amortized loan, your equity is growing, which is great. So that's a key benefit of rentals. And also you get to depreciate the asset. So there's a tax benefit there. So rentals to me don't have to make a whole lot of money, because if you're paying down the loan, your equity is growing every single year. But what I don't want is to have a portfolio of rentals like they did in 2008 that's costing me money every month. So, we at 300 doors, we were cash flowing net right around that $100 a month. I mean, that's realistically what we were actually cash flowing, 25, 30,000 a month. And that was not over levered properties. I mean, but we kept up with the repairs. And the good news is, when we disposed them, we weren't having to rehab the house. We were putting most of them in their as is condition, with very minimal repairs to pass a 4-point inspection.
Love it. No, I think that's great. I think that's a really good place to wrap up. I know you gotta bounce. You got that call you got to go to. So thank you so much for coming on, sharing your experience and stuff like that. I think there's a ton to unpack, and I think there's a good shot. We'll do a second one, because I think there's a lot of stuff we can talk about. If people want to learn more about you, get in touch with you, follow along, where can they do that?
Sure. Yeah. If you want to follow me on IG, it's at Real Lee Kearney on Instagram. And if you want to follow me on Facebook, it's Lee Kearney, Real Mogul. And if you want to go to our website and learn more about our educational platform, that's realadvisors.com. That's realadvisors.com. Or like I said, if you want to follow me on IG, it's Real Lee Kearney.
Awesome. Thank you so much, guys. If you're not already subscribed to the podcast, please do. And if you are, please share it with someone that you think would get a ton of value out of it. Lee, again, thank you so much. Can't thank you enough for the experience, expertise, and insights you just gave everyone.
Yeah, for sure. But thanks for having me.
Thanks.